And welcome to the week ahead for the week commencing September the 15th. Me, Fiona Cincotta, Senior Market Analyst at City Index. So as always, I'm just going to ask you to read through the risk warning. I'll put myself on mute whilst Excellent. So let's get started. So we're just going to start by having a quick look at what's going on as far as the markets are concerned. Quick roundup. We've obviously seen US stocks. This is the NASDAQ 100. We're looking at S&P 500 and Dow Jones all trading around record highs. We've got gold is also trading around a record high. And this comes, and the US dollar is struggling. And this is basically after more weak jobs data from the US, fueling and cementing expectations that the Federal Reserve will be cutting interest rates when it meets next week. So just a quick recap on the weak jobs data that we've seen, because we're going to hit off first of all with the Federal Reserve interest rate decision. The Fed will be announcing its rate decision on the Wednesday, the September 17th. And the expectation is that they will be cutting interest rates by 25 basis points. That's around 94% priced in that it will be cut by 25 basis points, and around a 6% expectation that they'll be cut by 50 basis points. Now, what has caused this sort of cementing of expectation has been clear signs that the US labor market is weakening. We've seen the obviously non-farm payroll report last Friday was significantly weaker than expected. This past week, we saw the revision to payrolls through to March 2025, downwardly revised by 911,000. We also saw US jobless claims rise to the highest level in almost 4 years. So there are clear signs here that the jobs market is weakening. And at the same time, we did see inflation rise. Well, we saw PPI inflation fall on a monthly basis, 0.1%, not expected, was expected to rise 0.3%. And on an annual basis, it was less than expected at 2.6%. And CPI, we did see it rise to 2.9%, in line with expectations, up from 2.7% in July, marking its highest level in 7 months as Trump's tariffs added inflationary pressures. However, whilst inflation is a concern, the Fed has made it pretty clear that the labor market is more important right now. And that's why we're seeing these cemented expectations of rate cuts for next week. And I think given that the rate cut is fully priced in, attention will be very much on the projections that we get from the Fed next week for growth and inflation. That will give the market a good idea of what to expect going forward. Market's currently expecting around 65 basis points worth of cuts before the end of the year. So if we see that those growth forecasts come down considerably, then maybe we'll see those rate cut expectations across the rest of the year increase. So I think there is a potential that we could see a dovish cut by the Federal Reserve, which could be beneficial to stocks, could help fuel the move higher in equities that we've been seeing, and could be bearish for the US dollar. Now, as I said, this is the NASDAQ that we're looking at here. Broke out of that symmetrical triangle that it was trading in. It continues early May, building on a series of higher highs. I mean, look at the uptrend that we've seen just over the past week, over the past 8 days, 7 days. In fact, it's been really quite strong. We're above the 24,000 level. Next level, blue skies above, is going to be the 25,000, so 24,500. That would just be the next logical level to be looking at. As far as support's concerned, support levels here, 23,550. That's the 20 SMA. It's also that falling trend line support, and potentially also that rising trend line, lower band of the rising channel as well. So they're something to be looking out for there. Let's just have a quick look as well as what's going on the Dow Jones. That traded and closed above 46,000 for the first time ever. It's been trading in a steady uptrend, series of higher highs and higher lows since really right back down at those mid-April lows, taken out that 46 level and reached a record high of 46,138 yesterday. We have just seen the price ease off slightly, just below 46,000 at the end of the week, but we're above the above the 20 SMA. We're above the rising trend line. So, you know, next level that buyers will be looking out for is that 47,000 mark. So that's that. And then just the other one also is gold. Gold's also been trading at record highs this week, supported by those expectations that the Fed will be cutting interest rates. Rose to that record high there of 3,675, just below. We are very overbought on the RSI. So, you know, a period of consolidation, even a move lower here is on the cards. As far as support is concerned, I mean, we've got sort of, if you like, the recent low that we saw at 3,600. So we can see a little bit of support coming in at sort of 3,610, somewhere around there. But otherwise, not too much to look at in the way of support until 3,500 on the downside. So I mean, and that's the high, the previous high that we saw set back in April. Below there, we've got the 3,430 level, which would negate that near-term uptrend and bring things into a more neutral position. It would actually take a move below here, the 3,300 level, to create a lower low, changing potentially the structure of this chart. As I said, plenty of central banks next week, and I think well, first of all, let's just have a look at the euro US dollar, because I think if we're talking about potential more rate cuts for the Fed, that's coming at a time when we're seeing the ECB actually leaving interest rates on hold. And, you know, there are questions over whether they will be cutting rates again at all. Now, if we're seeing the situation of the Fed cutting rates potentially quite aggressively into the end of the year and the ECB leaving rates unchanged, then that does leave the potential upside for euro US dollar. We're seeing this support level here, the 117 level. It's really still struggling to push meaningfully above that. We did see a sort of fake out just at the beginning of the week up to that sort of 117.75 level, but back down towards that 117 level now. Buyers, if we do get that sort of more dovish sounding Federal Reserve, particularly after the ECB said that they were quite happy with the picture of growth and inflation in the region for the time being, that could see this pair shoot back up towards that 118.30 level, the 2025 high. Above there, we've got 119. The ECB have suggested that they may get slightly concerned about the impact of the value of the euro when it gets towards the 120 level. So we're still not there yet, still not anywhere really near that. So there is still potential upside to go. Still, just as far as support is concerned, if we get a close below that 117 level, on the downside 115.80, that is the sort of levels that we're seeing. They were the lows that we saw at the end of August. Been in focus a couple of times, that level. That's also the longer term rising trend line that we'll be looking at there as well. So other interest rate decisions also coming from Bank of England. Now, Bank of England is not expected to cut interest rates, expected to leave them on hold at 4% in the meeting on Thursday. They cut interest rates in the August meeting. But we're seeing that growth has stalled at 0% month on month in July. That was data out today. But inflation remains sticky at 3.8%. We do have more data coming out next week ahead of the Bank of England rate decision. And so we've got CPI data, we've also got UK jobs data. So we'll be looking at inflation is expected to remain sticky, potentially moving up towards the 4% level as far as the Bank of England has forecast as we go into the final quarter of the year. And that comes at a time that we're seeing growth stalling as well. Now, fiscal difficulties are also continuing to provide a headwind for growth. We've obviously got the rising cost of servicing the debt together with Labour's contractionary fiscal policy, which are potentially hampering growth. Now, the Bank of England is not likely to move on rates before the Chancellor's budget in November, where she is expected to lay out tax increases in order to fill a huge black hole. As a result, we're not really expecting the central bank may not be able to cut interest rates in the UK until early next year. Now, on one hand, we might find that actually supports the pound against the US dollar. But however, if the market does become concerned over the deteriorating outlook for the UK economy, then we may find that the pound struggles into year end. But just having a look where we are at the moment. So we've managed to push above this falling trend line that dates back to that 2025 high of the just below the 138 levels. We've broken above that, but we haven't managed to take out really that 136 level. That's the next level that buyers are going to be looking to take on the upside. So if we get a dovish sounding Fed and a hawkish sounding Bank of England, then that could be sufficient to push that price above the 136 level up towards the 137 level. If we do find that we're sort of hearing more dovish commentary from the Bank of England, which is not necessarily expected, to be honest, given the sticky state of inflation, but if we see a particular weakening in the jobs market, which combined with the zero growth may unnerve policymakers, level on the downside to be watching is around here, is around the 135 is the immediate support. That's the falling trend line. It's also the 20 SMA. And then we have the 134.30 level as well, which has been a level which has offered support and resistance on numerous occasions. A break below 133.60 will be creating a lower low. Then we will also be looking at the, let's just have a look at the, we'll stick with central banks. Sorry, bear with me. Bank of Japan. Also, now, Japanese yen, US dollar hasn't been doing that much recently. I mean, we've been in this very familiar trading range for quite some time now. As far as the Bank of Japan is concerned, we are not expecting the Bank of Japan to move. We're expecting them to leave interest rates unchanged at 0.5% in the meeting this week, amid ongoing political uncertainty and as policymakers wait for more time to assess the impact of the US-Japanese trade deal. What we have seen is that the US trade deal is expected to result in another month of falling exports from Japan in August, and imports could also come under pressure due to lower commodity prices. Meanwhile, inflation is expected to ease. Headline inflation is expected to ease to 2.9% year on year on August, but core inflation should stay above the 3% level, and that is what's going to be supporting the potential for a Bank of Japan rate hike in the coming months. And that said, not really expecting any hawkish remarks from Governor Ueda, given Japan's political climate after Prime Minister Shiba resigned at the last weekend. So it could be that the US dollar is going to be the bigger driving force in this pair over the coming week if we don't hear anything that might rock the boat from the Bank of Japan. If we do hear, as I said, that sort of more dovish stance from the Fed, then be looking at a break below the 146.20, 146.30 level. That's going to be the break on the downside out of this trading range. Could spark a deeper sell-off towards the 145 level, creating a lower low there, changing the structure of the chart. On the upside, if we get a surprise from from either central bank. Perhaps a more less dovish than expected Fed could find that we get a move above that 148.65. That's the 200 SMA, and it's also this level that's been capping gains on numerous occasions across the past few months. A rise above there creates a higher high, bringing 150 into focus. And then just finally, just to talk about China. We've got China's monthly data drop, which is scheduled for Monday. We're going to see key data for retail sales, industrial production, and also fixed asset investment. Now, retail sales are expected to grow around 4%. And then we've got expecting, bear with me. We're expecting retail sales 4%, industrial production and fixed asset are expected to moderate to 5.6% and 1.5% year-on-year respectively. Now, poor weather conditions were the reason for, or the main factor behind, weakness in July's figures. So August is going to be very important to see whether it will be a continuation of the weak figures from July, which would point to the start of potentially a more ominous trend, or whether in fact July's figures were in fact just a blip. Now, this is the FTSE 100. This tends to be driven by heavyweight miners, which react to data coming out of China. Seeing the FTSE just trading up there, it's close to its record high, just below its record high of 93.60. We're actually up around 1% so far this week. We're trading back into that rising channel that we've been sort of in, or above that rising trend line that's been in place since mid-April. Buyers are going to be, if we get upbeat data from Japan, the buyers are going to be looking for a rise above that 93, the 93.60 level to create a higher high, and to basically bring the next level will be 9,500 as the next logical level on the upside. As far as support is concerned, you've got the 20 SA there at 92.50. Also here 92.100 could offer some support. A move below the 9100 level would create a lower low. So that is pretty much what we'll be looking at next week. I mean, that's the key focus. It's going to be central bank bonanza as far as what to be watching. Obviously, this is our economic calendar on the website, so do use that. There are other data points to be watching out for as well. For example, in Europe, we've got quite a lot of the sentiment figures coming out from Germany, which means the DAX may also be in focus, as well as the euro. Also got Bank of Canada also announcing their rate on Tuesday, but as I said, the main show in town next week is going to be the Fed. So I hope that you've liked everything that you've been watching and listening to, and if you do have, then we look forward to seeing you again next week.